This is The Way I See It with Steve Reitmeister.
Normally I'm getting at long-term investing has greatly changed. Well, I should. I'm putting my money where my mouth is.
Each week, Steve shares his unique perspectives with us on a wide variety of investment and financial topics. He tries to help investors by doing this chart the best course toward profits, no matter what the market has to offer. And certainly these days, there is no shortage of what the market has been throwing in front of investors. And today, Steve is going to be discussing exactly how the Zacks Rank is wrong, yes, you heard me correctly, wrong 44% of the time. So I have to admit now, I am just totally confused. And, you know, it doesn't take much to confuse me anymore these days. Isn't our goal, or your goal in particular, to kind of share with the audience the positive attributes of the Zacks Rank? At least that's what I've been hearing up until now. Telling customers that we pick losing stocks 44% of the time is kind of counter to that, correct?
It would seem like that on the surface, and there might be other folks in management who agree that I shouldn't be covering this topic. And if you don't see commentaries from me next week, you'll know what management thought of this idea. But no, I wholeheartedly believe in the Zacks Rank stock picking systems and how our earnings estimates are so powerful in picking stocks. But I think it's important that we show people the upside of it and perhaps its limitations as well, and the reality of it, what it means to apply this system to be successful. So yes, indeed, we are wrong 44% of the time, but yes, it does lead to a 30% stock return. And so, you know, we recently just concluded a study taking a look at a period between 1997 and 2007 with the Zacks Rank. And I just thought these numbers had to be shared with investors to give them a more realistic perspective on what it means to apply this system and have success. And if you remember, a couple weeks back, we talked about having great expectations for the market, but not too great. It kind of plays hand in hand with that notion as well. If people think that, you know, like the myths about the Zacks Rank, that they're going to be right all the time, or they're going to have big home run stocks, and that's not really the way the system works. They have these faulty expectations. They're not going to have the patience to see the system through, and they're not going to have success, which is the goal that we have for them. So that's why I want to share this information.
Okay, before we get into the study, I just had one other question.
Sure.
Don't customers get these lofty expectations from reading what my friends in the media put out there? Or the too good to be true ads, especially those that you get bombarded with in email and, you know, mail, hard copy mail. I mean, I get a lot of those in my email. I'm sure you do as well.
Yeah, well, I get a fair amount, and I'm sure most of the folks at home get it as well. Unfortunately, we're in an industry that has a lot of spammers and con artists that are part of this industry. I mean, right after getting emails about mail enhancement products, you'll probably get something about the next great Google stock, and, you know, something that's going to explode and things of that nature. So there's a lot of folks that are just 100% deceptive in their practices in our industry. But there's also a lot of legitimate firms that use very aggressive marketing tactics. And sometimes it's not what is said, it's what's not said. And it's the expectation that the customer walks away with. And so instead of me just pointing fingers at everybody else in the street, I'm going to even talk about some of the things that I see in our own marketing copy that, even though true, can lead to these lofty and unrealistic expectations. So let me just read off the list here. The Zacks Rank has a 30% analyzed return, nearly triple the S&P 500. We have beat the market 19 of the last 20 years. And if you had invested in the Zacks Rank starting back in 1988, a $10,000 investment would have multiplied all the way up to $2,090,000 by this time. All these claims are 100% accurate, okay? And yet, how is it that we can feel comfortable putting that stuff out there, or what is it that customers feel when they hear that information? What they feel is, oh man, they're going to be right 70, 80, 90% of the time. They're going to pick nonstop winning stocks. Well, as we kind of gave away here in the intro, we're wrong 44% of the time, meaning we're only right 56% of the time, and yet still all these performance claims are true. Oh, then it must be that they're picking home run stocks, that the stocks are going to go up 30, 50, 100%, and that's how they get to that performance marker. Well, the answer is no to that as well. The Zacks Rank is a short-term stock picking system. It's a 1 to 3 month time horizon. This is about hitting singles on a consistent basis, not home runs.
I see.
Or, you know, this system is so great, it's going to, you know, hey, the market's going down, but it's still going to keep going up. No, we have our rough periods too. Okay, and so here again, in the minutes that follow, we're going to go a little more into detail on the numbers, and from there, the clarity will arise how the system does come out to a 30% annualized return and give people that realistic expectation that we want them to walk away with.
All right, so you say that too often people see our performance numbers and assume we generated those returns by picking winners at an astonishing rate. Yet the reality of the situation is that we only pick winners 56% of the time, if I'm hearing correctly. So how are the Zacks Rank returns possible in that narrow margin?
Right. It's a combination of two things kind of working together as a catalyst for each other that will come out to that 30% annualized return. First, yes, if we are right 56% of the time, and that means we're wrong 44% of the time. Now, people doing quick math at home, they said 56 minus 44 equals 12%. But no, you have to do division. If you divide out the two, and I know this is a little more math than everyone wanted this morning, you know, I'll be checking your homework here in a minute. But what it means is we pick winners 27% more of the time than we pick losers. That actually is a decent winning percentage. And here again, if we had more time and people want to be bored with more math, I could show how we could be right 30% of the time and still beat the market. But 56% is a nice margin over the market. The next thing is you need your winners to be bigger than your losers. And you hear this quite often. People talk about, you know, cut your losers short and let the winners run. And the Zacks Rank does kind of work that way. When you put the winning percentage together and the winners being bigger than the losers, that's how you start coming up with that positive return. So I put together a slide here.
All right, and we haven't brought the telestrator in yet, but let's
here we go
to it.
And so the study is from 1997 to 2007, just so folks know. We are going to take the study all the way back to the beginning in 1988, but these numbers were so important, I felt it was good to bring them out now, even at this kind of halfway point of us going through the study.
All right.
So if we take a look here, on that top line we have the winners. And I said 56%, I was rounding off. As we see here, it's 55.6%, close enough. But the average gain was 10.8%. And so if you take a look at the line below that, you see that our losers, they were down 8.5%. So in other words, our winners are about 2 points better than our losers. But since we have that win percentage, you put the two together, we come up with this weighted average, and what it comes out to is that the average stock will go up 2.29% per month. Now, 2.29% a month, that's no big deal. Oh, but it is when you multiply it out 12 times over to get to an annualized performance. And so it is about that, you know, here again, consistently hitting singles, just having a little victory margin over the losers and having your winners bigger than your losers. That's what ends up with that 2.29% monthly gain, which here again, you consistently hit that over time, it comes out to 30% annualized return.
You mentioned earlier that people can also have unrealistic expectations when the market is going down. How well did the Zacks #1 ranked stocks hold up during market downturns? Any data on that?
Yeah, we have quite a bit on that, and we've had some pretty horrific periods in time. And again, I think it's important that people know that because, yeah, I'm proud of the long-term performance, but that included some dark periods as well. So take a look at some of the specific numbers here. The worst month that we ever had was October of 1998, and anyone who was an investor at that time or in this industry remembers what a dark and gloomy period that was. I mean, the market was raging higher and all of a sudden drops 30% in the matter of a couple days. That were some scary moments for folks. We only had 7% winners that month. Okay? So we were only right 7% of the time and wrong 93% of the time. But hey, everyone else was as well. And the average loss on the Zacks #1 ranked stock was 22%. Okay? In some of our marketing and educational materials, we keep repeating the same thing. Earnings estimates are the most powerful force impacting stock prices.
Right.
Well, that's true when the market is acting rationally. But in those times of extreme fear, the bad stocks are being thrown out and the good stocks are being thrown out too. Okay, so we have our tough periods as well. I'll put on another tough period we had, which was in July 2002. We're almost 3 years into a bear market. The market is racing towards bottom at this time. and we were only right 9% of the time in that month with an average loss of 12%. Yet still, even in that year, the entire year of 2002, where the market was down 22%, the Zacks #1 ranked stocks were up 1% on the year. So it's amazing that we were even in positive territory, but the point is we had some rough months in there, but over time, when the cooler heads prevail, the stocks, with the best earnings estimate revisions, they will be the ones that investors cling to, and they will be able to rise, not always into positive territory, but rise above the rest of what the market is doing.
Interesting. Well, this certainly puts a very real face to the Zacks Rank,
right,
and a realistic face to something that we talk about here a lot. And I think that that was important for investors who come to Zacks.com frequently to hear. And we thank you for that. Steve's opinions, as he kind of alluded to earlier in the piece, are his own, not necessarily those of Zacks Investment Research.
Fired,
yeah, he may be going, but I'm staying, okay? Or any of its subsidiaries or affiliates. With Steve Reitmeister, that's the way he sees it. I'm Terry Ruffalo.